Thank you, everybody. My name is Gilbert Garcia, and I'm here on behalf of Dallas Fire and Police Pension Fund. And I'm here with Martin Cabrera, who is of Cabrera Capital. And so this is going to be an interactive, fireside chat, as they say. But at any time, if anybody wants to ask a question, just raise your hand at any point in time. It's going to be a kind of a rapid-fire item. It's a very short presentation, so we're going to jump right in. And the only one rule is this. If I say anything and anybody wants to come up and slap me because of yesterday, I'm not going to resign from TEXPERS. So I just want to put that out there. So here we are. And let me just begin by saying, those of you who were in the caucus probably know what I mean, so I appreciate it. So let me just say that here's a joke that's not a funny joke, but here's something. If I told you, what does Solomon Brothers, First Boston, Kidder Peabody, Drexel Burnham, Merrill Lynch, let me keep going. Bear Stearns, Lehman Brothers, and I could go on, and many more. What do they all have in common? They don't exist anymore. None of them. And a lot of us who've been in this business remember them as giants. They were the behemoths, and they don't exist anymore. So there's always been a perception that somehow bigger is better, and bigger is better until it's not. And that's why we're here with one of probably the finest boutique broker-dealers, investment banking firms in the country, called Martin Cabrera. It's called Cabrera Capital. So Martin, let me just ask you, what is it like when you hear that type of thing, that all these giants, and they're gone, and Cabrera's still standing?
Yeah. Well, Gilbert, and for TEXPERS, happy to be here. And, we know that this is a very competitive industry, and I think for the pension funds that are out there, the money managers as well, you're always looking to find ways, how do you kind of generate alpha from every little aspect? And even for those big firms that are now gone, you learn from them and you learn from the mistakes as well. But it's a very competitive business. And one of the key things is that you have to keep reinventing yourself to be competitive. And it's great being a boutique firm because it allows you to stay competitive and hungry. And smaller is a good thing because you're more nimble and you can go out there and compete and see what your clients really need to see how you're going to help them grow their business. And our philosophy has always been, if you help the clients grow their business, they're going to probably help you grow your business as well. But the competition is key, and that's something that, it's going to bode well for the pension funds and for the managers, and really kind of for every little basis point or kind of every kind of execution on fixed income or equity that's going to generate alpha.
Okay, we're going to talk a little bit about generating alpha as it relates to all the pension plans. But before we do that, what's it like being an entrepreneur, knowing every day you're responsible for, and how many employees do you have?
We have about 76 employees.
So 76 families are part of your team. What's it like being an entrepreneur? And if there's an entrepreneur out there, a young person that's thinking of starting their own firm, whether it's a broker-dealer, money manager, or anything else, what would you say to them?
Yeah, so I think that life entrepreneurs, it's fun, it's taxing. You love it because you get to be creative and to go out there and compete against some of the biggest firms out on Wall Street, and you can beat them as well. And it's difficult because at times you're going out there, even when you're getting started, you're putting your house up there and kind of, risking everything to kind of start your business. But that fear of not being successful or not bringing value to your client kind of drives you to bring more to the table, to make sure that you're competing and for your clients that they are getting value and coming back to you.
So true or false, the business, your business, the investment banking / municipal finance, everything has changed dramatically since Lehman Brothers.
Yes, I think for all of the...
True?
Yes.
True? And how? Why?
I guess it's changed in the sense that smaller firms have to be creative. There's a lot of firms that provided research to kind of different buy-side clients, and they are out of the business as well. So you have to find that balance of where you're going to get value, what do your clients want to hear from you, how are you going to help them in the issues that they're dealing with pension funds, kind of from corporate pension funds, public funds, Taft-Hartleys, endowments, and foundations. So it's kind of staying on your toes and making sure that you're bringing something that's beneficial to the table. So even for a lot of the smaller firms, and I know I'm up here speaking on behalf of a lot of those smaller boutique firms, whether they're minority, women-owned, disabled veterans, but just smaller firms, that competition is what drives us. And we have to make sure that we're bringing some value to the client and that the client sees it in many forms, that it's not just the execution, but it's also kind of the other areas that we can be helpful in the investment banking side, which will kind of complement kind of what those money managers are doing and how they're bringing kind of the returns back to the pension fund.
So a lot of us are old timers and remember the Sullivan principles about South Africa. We remember the McBride principles, which was about Northern Ireland. Tell us from your perspective, what does all this ESG mean? We think we're navigating it as pension trustees, but what does it mean to you as an investment banker, and where do you see this going?
Yeah, so I think everyone's trying to figure out ESG, and I think you see it in your RFPs coming back to you from the pension funds, you know, from every corporation that's out there. They're trying to, it's a hot kind of word that's out there, ESG. Everybody wants to make sure that they are putting that down on their RFPs, that the pension funds are putting in their RFPs as well to be answered. And there's no straight metric or guiding principle that will determine what qualifies for ESG. But we're hearing it kind of here in the States, but also out in Europe. And, you know, for those firms that have other offices out in Europe, they're seeing it as, okay, this will kind of fall under ESG. And it's like, okay, providing liquidity pools and dark pools, that's something that is beneficial for the clients. That's how they are going to get, you know, better executions. And even for the smaller firms, the anonymity that folks are providing when big money managers are coming to trade, they want to make sure, and they've been specific, we don't want it going to Citadel and some of the other big firms where they may be front running some of those orders. So ESG is going to play a major factor kind of going forward, not just in Europe, but here in the States as well. And you have to look at all of your aspects where some of the money managers we've pointed out, and to some of the pension funds, that some of the things that the smaller firms are doing, it's actually beneficial that you can kind of put it on kind of your RFP back to some of your clients, that this is what's qualifying under ESG, and that you're not giving up any performance, that this is just accretive to some of the performance that you're bringing to the table.
So let's just say, when you look, there are many funds that are putting ESG as a shingle out there, and a lot of money's flowing in there. Give us some do's and don'ts to make sure our money, if we're putting money in a fund, is really going for ESG and our interests are aligned. In other words, should someone that's managing an ESG fund be ESG themselves?
Obviously, yes, they probably should be if they're going to market kind of the firm as kind of ESG friendly or investing in ESG kind of either stocks or bonds. And some of the folks are looking specific for green bonds, and they have specific parameters within ESG that they're trying to hit. So some of the smaller firms, what they're doing, and we've done it as well, is hiring some of the sales and distribution folks, sales and trading folks that have access to those buyers that are here in the States, but also in Europe and in Asia as well, so that they are seeing that benefits coming back to them in that ESG platform.
Tell us a little bit, you mentioned the term green bonds. Tell our audience a little bit about what is a green bond, and does it trade differently, and are you seeing lots of green bonds, or is it just sort of still new?
I think we're seeing more. There's green bonds that are being traded in the municipal bond market. And this is something we started working on probably 3 years ago. And some of the municipalities, even in New York and some of the other areas, there was a difference between issuing just traditional municipal bonds, and then green bonds were a little bit more expensive. But now, as ESG is becoming more prevalent, you're starting to see that gap starting to close. And you are seeing more on the green bond side as well, where some of if there's sustainability, some of the debt is being issued for some buildings for construction as well, and other areas of growth, that it's categorized as those green bonds, and that it can be kind of used, and you'll see it on the tombstones for all the kind of the major brokerage firms as well as the smaller firms, that these were green bonds, or kind of specifically for some of those clients, whether it was an endowment or foundation that may have issued $1 billion or $2 billion in ESG bonds.
Are there restrictions on what they can do with the money?
There are some restrictions, so they're supposed to kind of invest and take those dollars and use them for the proceeds for those green bond specific initiatives that were laid out in the offering documents. So that's something that they should be doing. But it is something that I'm sure all of you are seeing it. And I think for the pension funds, they're always looking to see, okay, how do we kind of be inclusive for ESG, but not give up any performance? Nobody wants to give up performance for anything. And that's where you have to be kind of very clear that it's not impacting the performance of the money manager and in the end, the performance for the pension fund.
So who's ahead of whom? Are we in the public pension plan space ahead of corporate plans, or vice versa as it relates to ESG and making ESG integrated into the funds and the process and everything else?
I think some of the corporate funds are probably leading the way, and part of it, when you think about just the hierarchy, a lot of those companies, whether it's Microsoft or Google or Amazon, those publicly traded companies, some of the biggest shareholders are the public pension funds. And it's those managers that are managing the assets, whether it's Vanguard or Wellington or State Street or BlackRock, those are the companies that are being asked by those public pension funds to be more inclusive. So now that the public pension funds are starting to look at some of the managers, not just the big managers, but all of the managers, to see how do we kind of take this and actually wrap it around where it's actually going to benefit us, and we're going to be generating kind of better returns. And at the end of the day, it's got to translate into better returns for the beneficiaries.
Do you think of the future is going to be every bond's going to have some sort of ESG or green component? Is it going to get to that?
I think that's where it's going. I think the hardest thing is to determine who is going to be that kind of, who's going to determine that governance agency to whether that qualifies as an ESG bond or an ESG component. I think for everybody in this room, that's what everybody's trying to figure out, because everybody can say, oh, we're ESG friendly, this is what we do. And you can't determine, you can't really say no that they don't. And you know, they might point to something that might qualify under either the E and the environmental or the social or governance aspect of it.
I'm going to change topics. I'm going to change topics to electronic trading. And again, anyone here ask any question about anything, but I want to talk about electronic trading. So electronic trading, true or false, has it been good for us in the pension fund community, the trustees?
So the electronic trading has been beneficial for the pension funds, for some of the money managers as well. And the brokerage firms, it's actually squeezed the profit margins. And so that's where I went back to my previous point that the brokerage firms have to be really creative and making sure that they're bringing value. Because the electronic trading platforms, you know, there are a lot of different algorithms, but even on the fixed income side, there's market access, there's TradeWeb as well, and most of those smaller firms are out there trading on those platforms, and they're competing. And they're competing with the medium-sized money managers as well as the large bulge bracket, kind of the buy-side firms as well. But they have to kind of use the technology to leverage kind of what they're doing to get the performance that they need. So it is squeezing margins, but as a brokerage firm, you try to make it up in volume as well. Some of the firms will make it, some of the ones you just named that did not make it, and you have to kind of determine how are you going to continue to generate alpha for your clients electronically and also generate profit so that it's a profitable business, because everybody on the buy side, they're in the business to make money, so are the brokerage firms. And as the market changes, you have to change with the market and stay ahead of the trends. But artificial intelligence is definitely, you're seeing on the trading platforms, you're seeing on the trading desks, even for the bulge bracket firms, there are fewer sales and trading folks on there, but at the same time, they cannot get that same color from the electronic platforms. So there is, a lot of the firms are just using electronic trading platforms, some are using both. Kind of the IB and Bloomberg's, but also having that market color and getting that insight that you can't get from some of the other firms.
Well, I think you may have answered this, but I'm going to give me a true or false. Electronic trading is going to lead to the demise of bond salespeople.
Yes, I think when you see what's taking place, not just in the trading pits, whether it's New York or Chicago or some of the other areas, you've seen now they're probably going to become museums. And electronics have kind of taken from in the trading platforms in the pits where they were sell, 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 buy, 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 and 4 contracts and 30 contracts. That has kind of diminished. And what is left are smaller pits. And a lot of folks have gone to the electronic trading onto the trading desks, and those that can survive. A lot of them transition, and they try it for a couple of years. They can't make the money that they were making before, and they ended up kind of closing down. But you are seeing that AI is having an impact on brokerage and institutional sales as well.
So we're not going to see in a movie, remember the old Blue Shoe likes Blue Star Airlines. Bye, bye. Remember, everybody know that movie? Nobody knows it. Well, it's Wall Street. Anyway, got Academy Award, but nobody knows. At the end of the day, do you ever see then, well, let me go the other way. My own view is, because I'm in the bond business and as my side, is I think there'll always be a place for salespeople, especially with those that always stay current and that really cover a broad breadth of clients, because you still need voice to know what's going on in the marketplace. And so I think there will always be a place for good salespeople. That's my own pitch.
Yeah. No, I think there's some great institutional salespeople out there, and even on the traders that are on the desk. I think when you're looking at brokerage firms, the buy side as well as the pension funds to be looking to, you're trying to get the most out of your money managers. And your money managers should be looking to get the most out of the brokerage firms and the relationships that they have. Before it was, it was kind of the good old days, and everybody's wearing suspenders, and they're like, okay, we have these relationships and we've been doing business with them for 25 years. It's like, yeah, that's great, but how are you going to be competitive? Because they're more expensive, and you have to go out there and bring value to the table. So a lot of the smaller firms, if you're just kind of in one certain area, maybe it's fixed income, maybe it's just equities, and you don't have a lot of different products that you can bring to clients, it's going to make it that much more difficult. So those in the industry where you're seeing it that have investment banks and the brokerage side of it, it complements one another. You're bringing more value to the money managers and to the pension funds as well.
Well, let me ask you this. So if you look at some of the big investment banks, they've been shrinking somehow over the last few years, right? Mainly because they had to build up their capital. Are you seeing a lot of their talent available to people like you?
Yeah.
Tell us about that.
You're starting to see some of the bulge bracket firms. We've got somebody that just joined us. He'll be heading up our public finance group. He was heading up Citibank's kind of public finance group. They were #1 in the state, and he just joined us. And it's looking at some of those top-notch producers and how they are looking at bringing value to the client that are now joining some of the smaller firms. And that's something where you see that they are going out there where they see the opportunity, they can bring more to the table as well, and just competing. And that's, like, I go back to the competitions. Like, I played sports my whole life, and no one ever picked me up. And people say, okay, well, even we're a Latino business, proud of it. But nobody picked us up because we're a Latino firm. Nobody ever picked me up to play basketball or football or volleyball because I was a Latino kid. You go out there and you get on the field and you compete, and you put it all on the table, and that's when people come back and say, hey, you're really good at what you do. You're great at this sport and in business as well. And that's where the smaller firms can be more nimble, where the bulge bracket firms, some of them, they have to go through 9 to 11 different levels to get an approval for something that is so minuscule. But that's where the frustration comes with some of the top bankers, some of the top institutional salespeople, and the traders as well. And that's where the opportunity comes for the smaller firms to attract some of those businesses to come and actually bring more value to all the pension funds and money managers.
This will be my last question on this topic, and then I want to go back and tie it all together. And the last question is, what is now electronic trading? Is everything on electronic trading? I mean, what all is available for electronic trading?
So there's many different platforms. There's algorithms. I think for traders and the smaller boutique firms as well, they know they have to compete. So you can't just take a trade and put it into an algorithm and just let it go and see how things turn out. It's like you've got to constantly monitor and then feather it into the market so that you are getting the best execution. And it's going against VWAP as well, the volume weighted average price. So there are a lot of different kind of electronic components that are really kind of there so that people can take advantage of. So I mentioned TradeWeb, there's Bloomberg, there's Market Access as well, and there's like folks that are trading, $2.5 billion a day in fixed income, or 750 million in a day in global equities. And it's not just here in the States. You're trading it in Europe, you're trading it in Asia as well, and looking to see how are you tying it all in. And I would say the investment banking component is a great complementary aspect of it, because a lot of the smaller firms that are doing it, they're bringing IPOs to those buy-side money managers. They're bringing debt offerings to some of those money managers. So the investment banking arm is working closely with the brokerage arm as well, so that they're doing what's called reverse inquiries, where we might have a buyer for 600 million come in and say, we're looking for kind of 600 million this three-year paper. And we go out to different corporations as well as for agencies to see who's going to compete for that and give them the best kind of levels. So you're able to do the deals now without the bulge bracket firms. And that's something that they're also doing share buybacks. So say we're doing a share buyback for a big tech company, and we're selling off for the next 6 weeks. And we've got other buy-side clients that you can cross those block trades with and really kind of take advantage for some of those buy-sides. So now the buy-side is seeing, it's like, hey, yes, you're a smaller firm, but you're that go-to firm to really go and execute all those trades for with bigger blocks.
Okay, I'm going to now go to the last topic, and feel free to ask any question. I'm going to tie it all together as it relates to us, the trustees and the pension funds. Was that funny? Which part? Which part? Don't slap me, though. Okay, good. Okay, I appreciate it. Let me know when you have a question, though. So continuing, I want to tie it all back, which is the ecosystem for us. We have the actuary, we have the consultant, we have the money manager, we have the broker-dealer community. That's the whole ecosystem to support our fund. What role should you play, the investment banker and the broker-dealer, for us to ensure that we're having all the best performance we can do and all the things that we need to pay our bills and to support our participants?
I think it is the whole ecosystem. I think for a lot of the pension funds, you might think it's like, okay, we're hiring the money managers and we're entrusting them to do a great job. But it's all the way down where you need the brokerage firms and investment banks to really be working for you as well to generate that alpha. At the end of the day, you have actuarial numbers, beneficiary checks that need to go out every month, and you need to be hitting those numbers. You need to make sure your managers are hitting those numbers. And if they're not pushing their brokerage firms and trying to get as much value out of them through executions, through equity IPOs or debt offerings, then you really need to look at that to see kind of what is it that we can be improving where you're going to get a better performance from your managers and some of the relationships that they have.
Do you think that we as trustees or our staff should be tracking the brokerage activity by our managers?
I think it's easy to go out there and track that. There are a lot of pension funds that do it. And you can kind of see kind of how the improvements have taken place. And I think we started this in Chicago. I know there's a couple of trustees that are here. And I think for the trustees are like, Martin, that's really not that important for us. We're focusing on the money management side. But over time, when they started tracking it, they started to see how the impact is having on different money managers and the value that those brokerage firms are bringing to the table. So I think there's a lot of, you have to look under every rock to make sure you're generating as much as you can in performance. And that's, you have to put the pressure on the money managers to do that. The money managers need to put the pressure on the brokerage firms to do that as well. And that's a good thing. It's like, look, competition, that's what our country was built on. There's going to be great firms that rise to the top. There's others that aren't going to make it and fall off. And, you know, even as TEXPERS, like we spend a lot of time mentoring some of those second tier and third tier brokerage firms to look at things differently. This is how you invest in your technology. This is how you invest in human capital. So it is that whole ecosystem that's going to benefit the pension funds in the end.
Excellent. And so let me ask you this. Is there any, we only have a few more minutes, is there any advice that you would give to us as trustees about what can we do better to work with our managers, work with our broker dealers, work with our custodians, work with our other vendors? I mean, you're a trustee yourself. Any guidance or any advice you have, especially for some of the new trustees?
Yeah, I think it's, look, the investment space is, it's not something you learn like overnight or even in a year or two as trustees. Some of you, it may be your first time, but you may be here for 5 years, but you're learning about alternatives. You're learning about kind of not just equity and fixed income, but all these esoteric, kind of money managers that are coming to you. And you have to look at it to see what is it that's going to bring kind of value to the table. And like some of the informational sessions, I think not only just the money managers, but talk to your consultants as well about what are you doing so that these money managers are providing more alpha through their whole ecosystem. And that is something when the consulting firms start to come in and start to play a role as well, they start to see where that value is going to come from and hearing the different perspectives from the different firms that are out there.
Excellent. We have about 3 or 4 minutes. Let me just pause for 1 second just to see if there's any questions in the audience for our speaker or for me. Yes, sir. On my left.
Want to know how you saw the Federal Reserve policy decisions impacting ESG funds and stocks.
Question was, how do you solve the ESG issues related to the Federal Reserve policy? Is that generally it? Martin?
I think from the ESG perspective, look, it was a crazy, probably the first quarter of this year has been very different. And I think for folks trying to manage, kind of especially in fixed income, some of the transactions, some of the debt deals that are coming out. So I think the ESG topic is still there, but you're starting to see it just with the global issues as well. It's like, one, you need to focus on performance first and foremost. ESG might be a second or third, but I don't think the issue is going away. I think it'll kind of continue to kind of come back up. But I think from some of the comments that we're hearing kind of internationally is that, yes, ESG is great, and we know it's something we need to work on and address and try to incorporate. But at the end of the day, I've got to focus on performance. And I think for most pension funds and trustees, that's where kind of their focus is to really kind of maintain the performance so that you can kind of go back and be able to cut those checks every month to your beneficiaries.
I'm going to add 2 cents if you don't mind, sir. And I have been very critical of the Fed, and I've been on record for that and those sorts of things. And my view is we as stakeholders in the ecosystem of the financial system should demand much more transparency from the Federal Reserve. I don't see why we have to wait for Fed Day and we're all there and everyone's there waiting to see should we buy or sell, and then we go through every single word they say. Is there an and? Is there a comma? Is there an or? It makes no sense. We should be seeing all the deliberations all along the way, and that way that information will be in the market, which will take out a lot of unnecessary volatility. And then on top of that, my view is I think it's outrageous that some of those Fed presidents and governors, et cetera, were able to trade during the part of COVID. I think they should be a lot of them, of course, have resigned. My view is I think they should give all those profits to charity. So I think it's incumbent upon all of us to step up and step out, and that's the only way to get change. That was my soapbox. Other questions?
I think one of the other things I just want to add is that when you're looking at the different brokerage firms, and money managers are looking at it as well, some of the brokerage firms will have their advisory groups. So those advisory groups are their investment banks where they are covering and representing different companies that are looking for growth capital. Some of them are kind of looking for 50 million to 100 million, but the investment banks can also kind of show that to some of their alternatives, some of the private equity investors where you're making allocations to, and they're desperate to find deals. A lot of the PE firms are chasing multiple deals, and they're chasing them up because they have to put the money to work, but sometimes the deals don't pencil out. And some of the smaller boutique firms are bringing some of those companies that weren't on the bulge bracket radar, but they are coming, and you are seeing a lot of those deals start to come from different firms that are not bulge bracket. And you're seeing it from all the major firms, TPG, Blackstone, KKR, BlackRock, and others that are looking to see we need deal flow. And that's where the brokerage firm as well will kind of come in and bring additional value.
1 minute, anybody? Then Martin, real quick. Diversity, has it been positive or negative in your business?
I guess diversity has been positive, but diversity is good, but at the end of the day, you have to perform. And if you can't perform, you shouldn't be at the table. It becomes, just what are the numbers? How do you bring value? How do you compete? And, like I said, love playing sports, but nobody ever picked me up. And, we didn't make any championship teams just because we're diverse. It was making championship teams because you hustle and you grind it out and you make sure you're out there performing and you're working as a team. So diversity is good at the end of the day, but it stems competition. That's the good thing and what you need.
Amen. I could see you as like a middle linebacker or something. So I can see you right now. Or maybe
Back in the
maybe
day, I was
center.
a tight end. It was
I
many
can see-
years ago.
I can see you right now. Well, ladies and gentlemen, please give him a round of applause. This is Martin Cabrera of Cabrera Capital. I'm Gilbert Garcia,
Thank you,
Dallas
everyone.
Fire and Police Pension Board. We'll be around if anybody has any extra questions, but thank you for having us.